YouTube, welcome back to the Investing on a 9 to 5 YouTube channel. It is your boy, the Dividend Dog. And on tonight's video, guys, we'll be going over my March Madness buys and what I'm going to continue to add into the portfolio. But before we dive into the video, guys, wanted to give you guys all a shout out there for sticking with the channel. I know it's been a while since I made a video here on the channel. Paul had to take a time of absence. He works got busy with him, so now I'll be running the channel full time here, guys, and I'm looking forward to coming out with at least one video a month for you. But shout out to you guys. If you're new, don't forget to hit the like and subscribe because we're going to continue to drop some fire content here from the channel. So as the title says, guys, March Madness buys here on the Investing on a 95. So we'll go ahead and dive into my picks. XOM, ExxonMobil, priced out at 105.84 right now. They're in the energy and oil sector, as you guys know. They did 3.7 million barrels of oil in 23. They're the world's largest oil refiner and chemical provider. That's one of the reasons why I like them. But another reason that I like Exxon is they have a strong balance sheet. They're very diverse across the world, and they have really good dividend growth history. And I think they're at fair value right now, or at least I think they're on sale. Fair valued on Stock Rover, they're saying it could see a slight pullback here to 91.85, which is a 13% decrease. But guys, I've been buying it. I mean, it was at 99 bucks about 2 months ago, and I decided to just hop in the water and see, just test it out. And now we're sitting up here over 100 bucks. I didn't know how long it was going to last underneath $100, so I tried to get as many shares as possible. So we'll take a dive here to see why I think they are a great company to potentially add to your portfolio. So they're trading at 11.9 PE. Sales last year, EPS, earnings per share growth, and EBITDA growth. The last years they took a huge hit with some lawsuits. So that and oil prices and crude oil, basically prices were not the highest. So these companies really can't perform, and they're very sensitive to the crude oil prices basically from around the world. Now, from a profitability standpoint, guys, across the boards here, gross, operating, net, they're all 25% gross margins, 13% operating margin, net margins at 10%, good return on assets, higher than their industry. These are just great ways to grade a company that you're looking at compared to its industries. Basically just saying like, oh, wow, I'm better than everybody basically in my competition. And that's one thing that ExxonMobil is, they pride themselves on and being a very profitable company. So we're going to take a look down here at their dividends, guys. So we got a 3.6 dividend yield, got a 41% payout ratio, and they pay out $3.80 per share. So if you have one share of ExxonMobil, they will pay you out $3.80 per year, and then they break it up quarterly. They have consistent dividend growth here. So the last 5 years, 3%, last 3 years, 3%, the last year we got 4.4%. So this is one thing that really halted them was last year the net income for the last 3 months total 7.6 billion, and that was down more than 40% because they had to pay like a $2 billion impairment charge to regulatory obstacles in California. I have no idea what the heck that is, but I saw like, oh wow, they had to pay $2 billion and something. Well, at least they had the cash to pay it, and that really affected that operating income, which, as you guys can see, helped basically pull back the company's performance. But Exxon's earnings per share for the quarter totaled $1.91. So hypothetically, if the company were to average that over a period of the next 4 quarters, that will put its payout ratio from 41 to 50%, which is essentially my threshold where I can consider that company to be a little risky, or they don't have enough cash to pay their dividends and also pay down debt and reinvest back into the company, et cetera, et cetera. But the current payout ratio is at 41%. And basically, if it continues to do that, it'll sit around at 50%, continuously. But hopefully it doesn't do that and they continue to keep it where it's at or go lower. But at a 3.7% yield, it's the highest one, in the energy sector, for their competition. Exxon is on track to deliver here in the future 14 billion of further earnings and cash flow growth potential over the next 4 years. So here's an opportunity here. They're expecting capital investments to generate an average of 30% with payback periods less than 10 years for greater than 90% of the capex. They're pursuing more than 20 billion in lower emissions opportunities. They're already up 3 billion, so they're transitioning to find lower emissions carbon, all types of opportunities out there as the world, changes to a lower energy, a lower emissions world, or however you want to call it. But they generated 9 billion in structural cost savings, which is awesome, with 6 billion more expected by 2027. So this is all future talking here, and basically making a hypothetical reason as to why the stock is on sale and why it's in my portfolio. So it's also increasing pace of share repurchases to 20 billion per year. So guys, they are buying back 20 billion of their shares right now. They're starting to do that per year from the Pioneer acquisition close through 2025, assuming reasonable market conditions. And say if the stock continues to go sideways like it's been the past 2 months, they are going to continue to dump 20 billions of dollars. And this is good signs that the company is also believing in what they are doing. Exxon is also working with another midstream company, Enlink, on additional carbon capture opportunities in the Gulf Coast region. They firmly believe oil and gas will play a vital role in fueling the global economy in the decades ahead. One of these factors driving that view is the emergence of carbon capture and sequestration (CCS) as an increasingly economically viable solution to reduce basically carbon emissions, guys. So they're trying to reduce carbon emissions. So they're going to be transitioning over into this market. And they say this market could become a 4 trillion global market by 2050. And this is the type of stuff that we are looking for as long-term investors. So that market potential is leading Exxon to explore new CCS opportunities. So they're exploring new opportunities to bring in more revenue, to basically lower that payout ratio, continue to give those dividend raises, share appreciation, etc. So they're going to develop new solutions in the Gulf region as the oil giant looks to expand its capability to capture this immense opportunity. And since then, guys, they've also linked up with industrial gas giant Linde and steelmaker Nucor, which is a solid dividend growth company. On top of that, it acquired Denbury Resources in a $4.9 billion deal to expand its carbon dioxide infrastructure platform. Exxon now owns the largest carbon dioxide pipeline network in the country at 1,300 miles, including 925 miles in Louisiana, Texas, and Mississippi. So read that one more time. Exxon now owns the largest carbon dioxide pipeline network in the country. Boom. Exxon also has access to 15 strategically located onshore carbon dioxide sites. So, guys, Exxon is going out to get opportunities, securing the largest carbon dioxide pipeline network in the countries. All of that is just cash flow flowing into your portfolios along with dividend growth, guys. Beautiful dividend growth history here. Kind of had a little stag here between 2019 and 2022, where crude oil prices was kind of messing with everything and with inflation. But now we're back onto increasing that even more, and hopefully in 2024 those things continue for us. So these are some of the major holders here for ExxonMobil. We got Vanguard Group here, the largest one here. What do they have? 387 million shares. That is a lot of shares, people. But overall, 4,000, a little bit over 4,000 institutions are holding it, which is huge. I like anything over 60% of shares held by institutions, which is a good sign. That means the institutions are basically putting it in people's 401ks, their long-term portfolios, and so on. Basically doing the same things that you and I are doing, do it ourselves investing. Here at the bottom here, we got my average cost of $100.16. It was at $99 and some change. Right now, I currently have 32.85 shares. Hopefully, looking to get at least 50 to 100 by the end of 2024. And it is, I know it says 55% of the portfolio, but that's 55% of my Roth, not my entire portfolio. So from an analyst standpoint, guys, here, it's a strong buy. Stock Rover's got it as a buy. We got solid estimates here leading from basically March of 24 all the way to next year of 2025. Estimates are basically increasing here for ExxonMobil. And then boom, here we got the crude oil prices. Crude oil is up 13.71% as to why some energy stocks are starting to gear up and get ready to make a run here for 2024. This is one of the things here that really affects or makes our energy and oil stocks very volatile. So from a forecasting standpoint, from an analyst, they're saying a 127.31. The highest it can go is to 145. Even if we were to flop down here, we can get a 110 target price here. But from a high standpoint, you're looking at a 37% gain here just by purchasing it right now. Once again, this is not financial advice. And that was ExxonMobil, guys. Now we're going to hop over to my next ticker here. Amazon, ticker AMZN. Now, you guys already know how I feel about Amazon. Amazon is on freaking fire right now. The last year, it is up 93%. Year to date, she's up 17.3%. The last month, up 11% right now. So compared to its industry, it is doing pretty well here. Got a peg forward of 2.9, which is expensive. Anything above 1 will be considered very rich, essentially. But we own Amazon and we know what they do. They got a price to earnings right now of 61, but that forward PE is trading at 33.6, which is a good sign. Got a fair value of it at 188.07. So this fair value is basically saying it's a safety net, not financial advice. But if you were to get in right now, it can at least, you have at least a 6% margin of safety here on the stock. You got a target price on stock. We're over here at 202.25. Earnings per share, 25%. Surprise. Sales growth next year, 11%. You got the 5-year earnings per share growth, 16%. Got the current earnings per share right now change, 42.4%. Now, Amazon is very rare you find a company that is dominant literally in like two industries like Amazon. They're e-commerce global giant, aka the big blue trucks, and then you got the Amazon Web Services, which I think is their key profit center. Last year, the Amazon AWS was 14% annually. It brought in 145.7 billion dollars, just from the AWS standpoint. So for quarter four of 23, Amazon posted a revenue of 169.9 billion, which was up 14% from the 149.2 billion dollars earlier, a year earlier. Sales were also up 19%. Revenue exceeded the high management 167 billion dollar guidance and beat the 162 billion dollar consensus estimate by more than $3 billion. So it clearly smoked it. And this is one thing that we look for when you're investing into a company that's not really, that doesn't pay you a dividend. You have to look for consistency on the earnings. This is the first place I go and hop to see if there's any consistency. They're beat. This is awesome to see from Amazon. So from a value standpoint, 61.4 PE, very rich stock, but we own Amazon. We know who they are and what they do and how they make their money. So you basically have to know what you own. Profitability standpoint, guys, gross margin, operating margins, net margins, return on assets, return on equity, return on invested capital. Either they're in line or higher than the industry. Now, their gross margin isn't as higher as their industry because they have some really high competitors, some big time players in the competition, like Google, Microsoft, and Apple. So those are all big time players. So, there's still room for Amazon to grow, and they are actually continuing to grow a little bit harder this year, I think, compared to what they were doing last year. So here, I like to go look at the cash flow statement. So this tells me basically the net income and operating cash flow. So in 2022, net income was negative. It had hit a negative, basically negative form, negative 2 million. Now net income has jumped up to 30 million, which is huge. Same thing with operating cash flow. Right here at the bottom, guys, went from 46 to 84 million, 81.69% operating cash flow growth. And here's why. Andy Jassy, basically the new CEO, who has had an embattled basically first few years on the job, which as you guys can see, they're struggling here 2021, 2022. Basically noted that the fourth quarter of last year was a record-breaking holiday quarter for Amazon, and they closed out their robust 2023 in which sales rose in double digits, which is huge. The company generated record cash flow from operations of 85 billion, nearly doubling the 2022 tally. So this, yeah, basically here we go right here, basically doubling it, guys. And this just all goes back into the CEO. He came in and had a game plan. They're paying down debt. I think their debt went from 67.2 billion at the end of 22 to back down to 58.3 billion at the end of 2023. So they are lowering the debt. They're also increasing that cash flow as well, guys. Cash flow in Amazon went from 46.7 billion in 2022 to 85 billion in 2023. So there's lots of consistency there on two, not all factors, but two prime factors to see if a company is worth adding your dollars to. And here is a analysis from Jim Keller. He said holiday quarter strength, positive outlook. Amazon reported above consensus revenue. It's things that we've already talked about. The AW business, which has showed some signs of deceleration in 2022, appears to have been energized by the global push because everyone now has gotten their shovels out and they're trying to figure out where and who's going to be the best AI company or who has the best AI tools. I think Amazon may have the competition beat. So AWS could have an essentially big opportunity as generative AI technology evolves. Management said there has been a lot of interest in AWS generative AI products, such as Q, chatbot for business, and Jassy said that AI could drive 10 billion tens of billions of dollars in revenue over the next few years. Amazon is developing its own AI chips and has a platform to build AI applications and among other initiatives, which is awesome. Furthermore, it isn't just that's Amazon's business that has a lot of room to grow. It also has the opportunity to improve efficiency and expand its margins, especially on the e-commerce sides. The rapid growth of advertising should certainly help, and Amazon is making efficiency improvements in its fulfillment network. A continued focus on efficiency is a big priority for the CEO. Another thing that can help from the AI perspective is a sector known for still relying on the fax machines is finding its way into the tech age as competition heats up out here on the streets. So companies like Microsoft, Amazon, and Google are basically trying to find out their next generation tech that is going to basically help free up doctors and medical staff that are swamped with administrative tasks. In addition, health insurers have been experimenting with ways to automate the claims process with AI. So AI could produce productivity, cut costs, and improve care, just as the industry are facing here in aging America, essentially. So for investors, the effect of the technology will begin to show for insurers, pharma giants, hospital chains, software makers, and many more. See, there's a positivity behind AI right here, guys. Also, Amazon has just invested $10 billion in two data centers in Mississippi. That means that they're going to have two. I think they're going to do two. Yeah, it says here two data centers in coordination with the Madison County Economic blah blah blah. AWS will establish multiple data centers in two Madison County industrial parks, which create at least 1,000 jobs in the state of Mississippi. And Amazon said it has invested 2.3 billion in the state since 2010 to build this infrastructure, including 5 fulfillment and sortation centers. So just looking at a little chart here on Amazon, right here we got a trader at 178.22. Got a little line up here marking at the 188 because it looks like we hit that high back in 2021 going into 2022. But I think we've been on a run here since about October of last year, and then when it was really underneath the $100, it was a really good time to get into the stock. I still think it's a great time to get in under 200. Also, these are my shares down here. I currently have around 40 shares, but we're currently up 18% here, and it's been doing well in the portfolio, and I expect big things out of it this year. At the high, they're looking for it to hit 230, an average of 182.29, and the lowest they say it could flop to 116. Let it drop to 116, and we're backing up the truck. I'm just kidding. Here's some estimates here. Moving forward, I mean, by the end of December 25, I mean, there's having the average estimates per share to be $5.31. So these are all solid estimates here. Just from an earnings per share standpoint from analysts. My next and final stock, which is basically new to the portfolio, I basically took some shares from the Celsius run that we've had. I got in at around 49, $50. And when it hit around 82, decided to take a little pullback here. And I was able to go out and capture like 6 to 7 shares of Google. Everybody knows what Google is. Google, 3.5 billion searches per day, $1 trillion searches per year. And Google Maps have over 1 billion monthly users. Also, they own YouTube. YouTube has 2.49 billion monthly active users. 47% of the global internet, guys, uses YouTube. Only 47%, not even 100% of the world. Imagine when the other 50% get a chance to know about YouTube and Google and the internet. And also, people are getting paid from YouTube now, from Google, ads, reviews, businesses. What we're doing here right now on YouTube. So this is a vital, vital company, and this is why I'm adding it here to the portfolio. So right now it's at a peg forward at a 1.1, which is lower than what is Amazon. I think it's a 2.9. So good value here. I like it right now, 137.14. The last year, 51% return. The last 5 days is down 5%. The last month is down 2%. It's got a margin of safety at 159.29, so 16%. And it's got a 160.97 price target range, so which is basically saying from here to there is a 17.38 increase in the price. Got earnings per share current right now 17.1. The 5-year earnings per share growth estimate is at 19.3%, and sales growth next year is at 10.5%. So from a price to earnings standpoint, 23.6, a little bit lower than the industry, a little bit lower than Amazon, right, guys? And then look at here the profitability standpoint. Huge numbers, way better than Amazon, right? But this is a cheaper stock than Amazon. So not all the stocks that cost the most are the best companies to invest in, and all the companies that are cheap are the best to invest in. This is why it's important to go and look at the metrics here. Look at the growth that Google here is putting out here, guys. Huge growth here. All positivity, higher than or in line with the industry. So the revenue estimates for this quarter, next quarter, and the next year, all increasing from a revenue standpoint. Their free cash flow is growing. They're paying down debt. They're also keeping earnings. So retained earnings means like how much are they keeping after their earnings? And their retained earnings is increasing, meaning that this is also going to help that free cash flow growth. So when these companies have a lot of free cash flow, when interest rates are low, they can take that money and go invest it into different entities such as AI to help the business grow and be more profitable. So they have it here at a high 180 price range, as we talked about. I'm just showing you different angles of it here. Got an average of 150.68 and a low price of 117. So you're looking at a 31% price target here, just by purchasing it in right now. Once again, it's not financial advice, but as you can see here at the bottom, I got in here and got 5.5 shares. I think I said 6 shares or something like that. But I'm looking to add some more this week here. If it goes high, if it goes low, anything under 180 for 160 for Google is a good add in my book. Once again, it's not financial advice, but how many people use Google a day? I mean, it's a moat. It's one of the largest companies in the world here, and they're all attacking to go against competing with each other for AI. And guys, thank you for being here on a Sunday night. I know you guys are getting ready for the work week, but I had to get this video out to you guys to show you my 3 March Madness buys here for this month and how I'm attacking it with the portfolio. Hopefully, guys, if you're new here, don't forget to hit the like and subscribe button and share it with all your friends and family. I'll catch you guys in the next video. I'm out.